Welcome everyone. Hello, Bharat Bhai.
Hi, Kamal.
So on this Saturday morning, it is real pleasure to converse with you, kind of wisdom that you bring with yourself, more than 3 decades. And we are kind of lucky to have seen over last, I would say almost 15 days, the cheers back in stock markets. We have been waiting for stock markets to again cheer us almost for 2 years, especially for a strategy like yours, which I am quite fan of, which is investing in growth and quality. Over the last 2 years, there have been kind of a lot of changes in the way I would say stock markets are seen, especially in India, in terms of how investors were kind of favoring growth style of investments over last entire decade. And then over last 2 years, that entirely changed, whereby some of the growth focused businesses were seen as very expensive businesses. Markets were actually ignorant of their valuations, till some time back. But in last 2 years, as interest rates went up, growth style totally went out of favor. And on the other side, value style actually became, I would say, attractive for investors. So in this entire 2 years of testing period for you, Bharat Bhai, how did you kind of sail through it? What were your learnings, and where do you see is this kind of now change that has happened from growth to value here to stay, or it was just a temporary phase?
First of all, Kamal, on various occasions, probably with you as well, I had an opportunity to discuss that these distinction between quote-unquote growth and quote-unquote value is an artificial distinction. Investing is not bucketized, and investing, people for convenience sake try to put tags and titles, and much like people find it convenient to describe valuation with price earning multiples or price to book ratios, which are convenient but deficient way to describe value of a business. Much like P and price upon book are deficient ways of describing value, describing investment philosophy and approach through value or growth prisms are actually, false and somewhat deceptive. Ultimately, all the businesses, if they have to create value, they must grow, because if businesses don't grow, they actually regress. Even in nature, nothing stays where it is. There is nothing which remains in the same state on a forever basis. If something doesn't progress, it actually regresses over a period of time. Therefore, growth is an essential elixir of investing. Without growth, there cannot be meaningful value. And in all probability, without growth, value doesn't remain nearly same. It actually declines over a period of time. Secondly, quality, and I'm coming to value as the last. Quality is a very, very essential ingredient. Quality is not a fetish. It is not a shibboleth. It's not an article of display in an artificial way that you want to buy a quality business. Quality is at a root of real investing economics. Quality ensures that the businesses remain viable for long period of time. They become predictable. They become durable. And predictability, durability, longevity has a direct implication on the value of a business. Two things being the same for a given period of time, but something is more durable, something is more predictable. something is more solid, that clearly would have a much, much higher value. And therefore, quality is not merely an intangible art kind of a description. It is at the very root of mathematics of investing. Because quality imparts that longevity, durability, predictability, solidity, it improves the value. Secondly, quality protects because businesses don't remain forever in a single state. There are challenges all the time, and environment changes. Good businesses, quality managements, and quality businesses have a capability to deal with the challenges and vicissitudes of the environment. Therefore, quality has not merely role of expanding the value, it is also the role of protecting the value. And third, quality really, is an unseen but a very real element in mathematics of investing in terms of an additional returns that it brings. It's popular to say ultimately all stock prices are slaves of earning power, and which is true. Therefore, the long-term predictable earnings and cash flow growth of a business is a fantastic proxy for long-term compounding returns. But what is not seen is an additionality which is brought by quality over and above the growth rate of the earnings is a set of return. And there is a clear historical evidence over hundreds of years, over thousands of businesses, that why businesses generate returns greater than the underlying long-term earnings growth. And that extra actually comes from the quality. Therefore, quality protects, quality improves the value, and quality aids to the returns in over and above the earnings growth. The third factor is the value. Ultimately, a good business, a growing business, and a qualitatively sound business is the only one that you want to buy. But even that business you want to buy at a sensible price, at a value price, at a margin of safety, where price is cheaper compared to the underlying intrinsic worth that you believe that exists. Of course, value is a conjecture and it is a moving number. It's not a static number. With new insights, with new understanding, with new developments, value may undergo revision of its own. And therefore, that's a forever constant task of revisiting the value if there are any change in the factors that may affect positively or negatively the value. But you do not want to buy a quality business or a growing business at any price. You want to buy them at some discount to the value that you believe exists today. That discount comes in the form of margin of safety. Therefore, the first two elements, growth is an annuity. Quality of growth also is an annuity. Both happen over a period of time in future. The third element, the value, the margin of safety, is a one-time extra. But even that one-time extra unfolds over a period of time. Let's say value of a business today is 100 and the price today, let's say, is 80 rupees. Then the margin of safety is 20%. One-time extra is 25%. But that 25% may unfold over 5 years, 7 years, 8 years of investing that you may do with the business. And therefore, that is the third element of a return that you are seeking to get. When you complete the two annuities, future growth, second annuity of the quality, once again unfolding in future, third element, which is one-time, margin of safety, but it is one-timer, but it unfolds over a period of time. These three elements put together describe completeness of investing. And therefore, trying to choose something artificially as value and something artificially as a growth is a very incomplete way of investing. Ultimately, all good investing is value investing. Ultimately, all good investing is growth investing. And ultimately, all good investing is quality investing. And there is no either or. There is no mutually exclusive club. It all interacts together, and all three elements have to combine together.
Sure, Bharat Bhai. I think you've explained this quite beautifully, quite comprehensively, and nobody else than you could have done it as well. The real then subsequent question that if I think from investors' point of view comes to mind is that obviously it is the hard-earned money and quality cannot be compromised. Quality comes at certain price, and fund managers know how to assess that price, and right valuation is something where we hope and kind of believe that fund managers like you ultimately invest hard-earned money at. Now, over the last almost 15 years, we have seen world kind of living in almost zero or very low interest rate environment where value was something which to an extent was acceptable, even if it is to an extent expensive. But now in the current context where kind of we are back to Federal Reserve rates as close to 4.5%, 5%, which were there before 2008 subprime crisis. What are your views, generally speaking, over next, say, 10 years in such an environment about equities and asset class in terms of possibilities of returns? Will the returns that we have seen in the past be similar like we'll see in the future, especially in the quality and growth style, which comes at an definitely to an extent expensive valuation?
No, again, I'll differ on that last statement at an expensive valuation. Quality will have bearing on determining value. Growth also will have a bearing on determining value. When the quality is superior, the return on capital employed compared to cost of capital is superior. Therefore, economic value added is high. And that economic value added per annum on a rising basis has a deep impact on the value. Therefore, expensiveness or cheapness will come thereafter. Whether the price is higher than the value, then it is expensive. If the price is cheaper than the value so assessed, then it is not expensive, but it is value purchase. Therefore, automatically assuming that quality and growth will make it expensive is only a very partial statement. If your definition of value is a price earning multiple, then probably what you are saying is correct. That quality businesses and the growing businesses in price earning terms are likely to be showing more expensiveness, quote unquote. But as I made a brief comment earlier, the price earning multiple or price to book in case of finance businesses is a very inappropriate, inadequate, and inferior way to describe value. Value ultimately will be described by earnings, the cash flows, their durability, their predictability, the pattern of growth, longevity, quality of that growth is exemplified by return on capital employed. Growth in turn will be determined by size of opportunity and management capability to extract that opportunity. And your judgment of cost of capital at which you want to at which you think it is important for you to buy into an equity asset. All these elements in turn will determine value. Thereafter, the price comes into the picture, and if the price is cheaper, then it is cheap, even if in price earning multiple term it is high. And if thereafter price is higher than the value, even if whatever may be price earning multiple, it is expensive. Therefore, cheapness and expensiveness need to be described correctly. Unfortunately, they are described in a monolithic way of price earning multiple or price to book, which I would politely submit is not a best way to describe a value. And therefore, a lot of confusion about valuation and value and discussion about that happens. As far as the earlier part of what you mentioned, as to the interest rates and how the Fed is now forced to push up the interest rates. Europe has no choice, is in a deep sea or devil or deep sea kind of a situation. But I think Europe and America has created its own, and they've dug their own kind of a pit head to fall into. The interest rates were artificially driven low for a long period of time. In Europe, they came down close to zero at one point of time, a complete anachronism of negative interest rate we witnessed. America wasn't far behind, was a positive interest rate, but materially inconsequential interest rates. And then when the war occurred, they were caught naked with supply chain disruption, raw material price escalation, oil price escalation, inflation came roaring. They have no other option but to raise interest rate now. But if they raise interest rate in this environment, they push themselves further down the pit end, much deep down there. And therefore, they are in a devilish kind of alternative situation. But that is a problem that they have created. Irony today is that Indian benchmark bank rates are not very different from American interest rates, just by 150 basis points. But our real interest rates are positive. America and Europe real interest rates are deeply negative. And that is a real story. We don't have to slavishly follow American interest rate syndrome or the European interest rate syndrome, because that is based on their undoing or misdeeds, what they've gone into. We have systematically brought down inflation by controlling fiscal deficit, by controlling current account deficit, and therefore our interest rates are appropriately aligned to where these numbers are. Therefore, I don't know these style variation that we are talking of, but I believe we are at a cusp of an unprecedented opportunity. I think what we are going to witness ahead will be the greatest economic expansion that this country has ever witnessed. Not only in terms of what it has been in the past, but compared to the rest of the significant world. And the growth of the economy of India will be distinguished not only by large expansion and high growth rate, but much more superior quality, greater predictability, greater solidity, greater durability, and therefore it will have a greater engine for value creation. I think all that will reflect into the cash flows and profits of the businesses, and therefore their value, and therefore the wealth of the owners of these businesses. Finally, it will reflect into the portfolios of patient, wise, and disciplined and long-term investors. I have no doubt whatsoever that this is going to be not only a rising crescendo for India, but it is going to be an unprecedented one. For economy, for businesses, for value creation, and for the investors. And therefore, compared to any other period in the past, the period unfolding is going to be a dramatic one. And Aishwarya talked about 5 years. You talked about 3 to 5 years. I'm not really confining myself to 2 or 3 or 5 years. I'm really saying more like 10 years and 15 years and 20 years. That is the real gigantic size of opportunity. One thing is, an attractive value creation, but in a limited period of time. But when attractive value creation occurs over a longer period of time, it acquires a compounding powerhouse of a force. And I think lifetime of value creation opportunity virtually is lying ahead of us, because this period will account for the coming decades will account for 90, 95, 97% of the value creation of an investor of their portfolios. Meaning, what they have a portfolio today, and maybe 20, 30 years down the line, this portfolio may look like only 2%, 3% of the total value at the end of that.
Sure, Bharat bhai. I think your optimism is contagious, and I am although in the opening speech itself, I myself mentioned that probably we'll call the bull run which has begun as father of all the bull runs, and you have kind of acknowledged that. And I again say that absolutely all of us are quite bullish in this context.
But Kamal, I must point out, this is not going to be free from volatility. Volatility is an alter ego of markets. The second name of markets is volatility, violence, blood, gore, what have you, And therefore, that is never going to alter. Time to time, you will see volatility, sometimes pleasant, depending upon where things are, sometimes unpleasant, sometimes rude and downright damaging, sometimes overzealous and punch drunk. But through that volatility, through that violence, and through those major changes, if you see it closely, you will see that volatility and violence. If you see it from a distance, you will see a nice, serene, upward sloping curve, gently going up and up over a period of time. So volatility will be the part of it, but ability to withstand and be resilient to that will be the key.
No, absolutely. We acknowledge that. And that is the reason, we have kept the topic for this event as rise of alternates, because, on one side, if there is a bullish phase, an unprecedented bullish phase, and at the same time, high volatility, obviously that is going to give rise to massive rise of alternates. And that's why, there are a lot of topics kept in this regards. Moving on to the next question that comes to my mind, Bharat bhai, is that now, when we are trying to kind of give some kind of indication to our clients, to our audience, in terms of the times ahead over long term being very, very bullish. So according to your learnings over last 3.5 decades, where do you see kind of, weights of various sectors moving over, say, this long period of 10 years? So where do you see kind of, today, Nifty's heavyweight sectors are like financial services, followed by IT, consumer. So do you see the same weights kind of, after 10 years, or some new sector from bottom will emerge up, or some top sector from top will go down? So because, if we are able to understand this complexity, it will obviously help generate alpha, because that's the ultimate thing that every investor looks for.
No, I think change is definitely is again a alter ego of markets, much like volatilities. Therefore, things will change, businesses will change. Some businesses which may look standard at a point of time may undergo modification, and some of the businesses which may be disregarded may acquire a great charm. So that change is forever going to be there. I don't think I really have any ability to predict what kind of changes would occur, because that will amount to soothsaying. Rather than attempting to forecast, I would prefer to observe what is happening and adapt to that change, and to be able to benefit from that. Because when you try to forecast the trend or the change, you automatically tend to fall in love, and then you assume, then you give it a reality in your own head, whether there is an actual reality in the physical world or not. And you fall in love, you get carried away by generality of that trend rather than specificity and micro specificity of each business that you need to evaluate. So I would prefer to observe. I'll prefer to remain a student of what is happening rather than trying to make any soothsaying forecast or those long range predictions, that I would leave for consultancy firms and many of the soothsayers which are bound for them to make. I have more mundane aims in life, and I'm a bit of a frog in the well. I'll prefer to see what is happening, try to keep keenly absorb these changes, and trying to form a picture in terms of a framework. And based on that reality that hopefully I'll be able to observe, and a picture that I draw to my mind will be more realistic. Because to drop a picture like a theory of relativity, to conjecture that, requires the genius of Einstein. And we all are very petty individuals. We don't have that capability to make such grandstanding ability to make those forecasts and ability to come up with those ideas, or to be able to understand planetary motions by just observing sky or apple falling from a tree. Newton can come up with a law and an idea, but ordinary individuals like me have to work harder. And therefore, I will prefer to observe rather than make too many predictions. And it is that observation, hopefully, that I'm able to observe and imbibe will result in likely frameworks that may emerge. And I'll prefer to adapt to it and to be on top of it, hopefully, rather than make any predictions. But your point about change, for sure it will be. Nothing remains the same, and therefore changes will be there. More than ability to predict changes, how we adapt to changes is a critical bearing on investing outcomes.
Sure, Bharat, I think you have summed it quite nicely. Before we start our next session, there is one last question that I would like to ask you, which my clients have been pressing me to ask. Because everybody ultimately who hands over money to fund managers is looking for an alpha. So ASK's products across have been giving very decent alpha for a very long period of time. But of late, there is definitely something like alpha which is missing. So what is it that you as thought leader behind ASK strategy are trying to bring a change, or you see this as a phase in terms of kind of giving guidance to all these clients and investors who have a long-term horizon, who believe in quality, who definitely find a lot of comfort in the quality and growth approach and are very patient, but still kind of, they somehow at times doubt because, alpha is not something which comes always.
Okay, I'll answer it in two parts. First, philosophical and then empirical. Philosophically, there are two things very dear to us. A, we must generate satisfying absolute outcome. And B, we must produce a relatively superior outcome over a period of time. Both of these remain sacrosanct to us. These are sanctum sanctorum for us. The purity of investing is about absolute. That without the help of Mr. Market, by arranging your investing affairs in a sound way, by managing risk in an intelligent way, by picking and choosing businesses wisely, whether you can generate absolute, satisfying, compounding outcomes over a period of time or not. That absolute outcome is an absolute must. And to my mind, the first principle of investing is to be able to say that you will generate an absolute return over a period of time, and satisfying one, even if Mr. Market is not rendered any help to you. So long as Mr. Market has not hindered you, even if Mr. Market has not helped, you have to have a confidence that you will generate an absolute return. Second, when you follow the purity of absolute, relative superiority automatically happens to be a byproduct. You drive a car by looking at the front windscreen, not by looking at the rear view mirror. Relative comparison is that rear view mirror. But if you try to do rear view mirror driving, chances are, apart from it being inelegant driving, it will be accident-prone driving. And therefore, focus has to be on absolute. But when you do focus on the front windscreen in a steadfast manner, relative superiority of their journey and an outcome reaching in an elegant way in time to the destination, enjoying their journey on the way, also will happen automatically as an outcome. Therefore, we remain committed to both satisfying absolute and superior relative over a period of time. Not only we think there is an opportunity in the country and her markets and economy and businesses to offer that, but I believe it is our duty. So that's one part philosophical. The second part, again philosophically, before I come to the empirical one. If you have a well-formulated philosophy, if you have a philosophy of investing which is time-tested over material period of time, and which is seen to stem the ravages of time and through various cycles, and global investing history of more than 300 years, has enough evidence available if you are a student of that history as to what has worked and what has not worked in a long-term manner. Now, if you have a good philosophy which has been time-tested and which is productive in generating satisfying absolute and superior relative, then, and if you follow that philosophy with discipline, I would say it is inevitable over the long-term journey, there will be a phase when you may or may not match with the markets. And not that it will happen often enough and regularly enough, but there will be phases. And there is a logical reason for that. Market is nothing but a sum total of different prices of the various stocks. Prices are nothing but a sum total of rationality plus emotionality at a point of time. Therefore, market at any point of time is a sum total of rationality and emotionality. Sometimes rationality dominates, some other time emotionality dominates, and therefore prices are influenced accordingly, and they deviate from rationality accordingly. But over the period of time, the role of rationality becomes larger, and role of emotionality relatively reduces, because over a period of time, we think better about things. At a point of time, we are more colored by what we see immediately. And to that extent, at a point of time, market prices are more likely to be influenced by emotionality rather than relative rationality. And therefore, markets will reflect time to time greater dosages of emotionality. And therefore, that is the game that markets win by. Markets try to trap you by playing on your emotions, and that is the strength of the markets. And playing on those emotions will be your weakness. Therefore, if you choose to be a good long-term investor, you want to play in area of your strength, which is to play by rationality, which is to judge the value and buying businesses at a margin of safety. But in the process, when you are driven by rationality, but markets at point of time could be ridden by emotionality, market prices may pull in a certain direction for different businesses that you may or may not choose to participate in. If you try to mimic market at that point of time and play the same kind of emotionality, not only you're playing a dangerous game, a game of your weakness rather than a game of your strength, and you're playing into the hands of market by weakness being tapped into, rather than playing into your area of strength. And therefore, invariably, chances are that markets are trying to trap you with that emotionality and you get sucked in. Not only you will make mistakes, but mimicking is never, flattery is never respected by markets. Flattery is respected probably by individuals because Homo sapiens are governed by emotions. But markets are ruthless over a period of time. There is no love lost for any flattery. Imitation is not rewarded with good returns by markets. Therefore, not only it is dangerous when you mimic the market in its emotionality, but it is actually downright unproductive when you try to do that because you'll be playing a weaker hand rather than the stronger hand. And therefore, there will be phases when markets put you in a snare and markets trap you. And playing into that will be an utter mistake. Of course, quite apart from that, you yourselves may make some mistake. That you may make a mistake of omission, you may make mistake from commission. Ideally, you do not want to make mistakes of commission because they are more hurtful. Some mistakes of omission would occur, but they shouldn't be too many. And so long as you play within those boundaries, that's perfectly, it is invariably the case that over a meaningfully long investment journey pursued with discipline, and when that journey is driven by philosophy which is sound and time tested, it is inevitable that there will be interruptions and rudeness where you will suffer humiliation of the markets. With the folded hands, when you see such phases, you have to bow before it and just observe and see whether you missed anything. You've not made any faux pas. If you have missed anything, if you made any mistakes, you rectify, reaffirm your proposition. But mimicking emotionality is a perfectly efficient way to destroy investment outcomes. And therefore, some part in a long journey, there will be periods when you will look less than adequate. Empirically, third part, over a long journey of time, any of our strategies with a vintage of over 10 years and more, then there are 5 strategies with the vintage of 10 years and more. The youngest being about 14 years, the oldest being 22 years. These 5 strategies all have produced absolute positive returns ranging from 16 to 20% compounded over a period of time, and alpha ranging from 3.5 to 6.5% per annum compounded over that respective time frames. So that is as far as empirical part is concerned, as far as we are concerned. I wouldn't have liked to talk about it, but since you asked me directly and specifically, I have replied to that third part. Otherwise, I would have given you only the first 2 philosophical answers.
Sure, Bharat Bhai. I think the way you covered this question was quite insightful. In fact, I was getting messages in between that I should give you a cue because we were little running late, but you were talking so convincingly that it was kind of difficult to kind of break your flow in between. Absolutely, I firmly agree with whatever you have said, and it is quite I would say evident that it seems that you have watched and kind of you have worked with stock market so closely that it's like become life for you, and kind of you have learned many lessons which can be applied on our lives from your learning of stock markets. Or I would say maybe you have lived life so closely that you have kind of learned many life lessons and applied them smartly on stock market. And absolutely, this is very much evident. Whenever I converse with you, I kind of get same feeling. And that's why I started by saying that, you are one of the most wise fund managers I've come across. Thank you so much for spending time today, and over to you, Aishwarya.
And I'll just make one last comment. Investing, as you say, is my all-consuming passion. And it is a deep and very integral part of my life, part of the sanctum sanctorum.
Thank you very much. We are, in fact, immensely grateful to our keynote speaker, Mr. Bharat Shah, the Executive Director at ASK Group. Thank you so much, sir, for sharing your valuable insights. And thank you, Mr. Manoj Shah, for steering that wonderful and engaging conversation.